Hi everyone, welcome back to X Unknown channel. Recently, the stock market is extremely volatile due to speculative investing. If you are a value investor, you will focus on buying good stocks and hold for long term. In the opposite side, speculative investing is just like gambling or betting, when investors are buying the stocks without looking at the fundamental analysis. There is a group of retail investors that started a war on short sellers in companies such as GameStop, GME. Look at the stock price of GME was only at $18 on 8th of January and has increased significantly. There are a few things that we will discuss in this video. First, why would investors do short selling? Second, how do investors short sell when they do not own the underlying stocks? Third, how did they end up losing money? First, why would investors do short selling? This is because they want to earn more money and make a profit using margin. Short selling is a trading strategy used when speculators are expecting the stock price to drop in the future. Hence, they want to sell the stocks now at the present market price. For example, as in now, the market price of stock A is $20. The short seller is speculating the price to drop further to $10 next week. The short seller wants to make use of the financial instrument by borrowing 100 shares from the broker and to sell to the market immediately. The cash inflow is $2,000. The ideal situation is when the price drops 1 week later from $20 to $10, the short seller can buy the 100 shares at a cheaper price with only $1,000 in order to close the short position. Therefore, the short seller is able to make a profit of $1,000. How do investors short sell when they do not have the underlying stocks? This can be done through margin, where the short seller just need to pay minimal loan fee, typically less than 1%, to borrow the stocks without actually owning the stocks. For example, in this scenario, the short seller only paid $10 to the broker to have the short position. Third, how did they end up losing money? The risk of short selling is unlimited depending on how high the stock price can go up to. For example, the stock price increased to $50 per share. The broker will want to make a margin call on the short seller. Hence, the short seller is forced to buy the shares at higher market price now. 100 shares of $50 equal to $5,000. The loss is $3,000. In recent case of GameStop, how did the fund manager end up losing billions of dollars? It is due to the stock price increased to as high as $390 at the end of January from just $18 weeks ago at the beginning of the month. The price has gone up 20 times its initial price, meaning for each stock that you borrow, it incurs a loss of more than $300. Okay, now we understand how the short selling instrument works in the market. Comment below, do you think this is ethical to short sell without owning the stocks? If you are a retail investor, will you join this battleground? Thank you for watching. See you again in the next one.